Larry, in your book, How to Listen to When Markets Speak, you lay out a hypothetical allocation for the 2020s. I want to read it off for viewers and listeners, and then tell us your thinking around these allocation percentages. So you're recommending a 10% allocation to cash, 40% allocation to stocks, 30% to bonds, and 20% commodities. How did you land here? What was the thought process?
Well, the 60/40 portfolio, and I'm really proud of the book. Robert Van Battenberg worked on it with us. He's our CFA, our strategist. And then, like I said before, I talked to David Tepper in the book. I mean, legendary investors are in this book. I sat down with Charlie Munger, David Einhorn. And, one of the things that David said to me back in 2021, he was really questioning risk parity. Because that's talk about another crowded trade. Everybody was long this 60% stocks, 40% bonds portfolio, the 60/40, and there was just look at the R-PAR ETF, R and then PAR, and the 60/40 portfolio, 60% stocks and 40% bonds, that has dramatically underperformed. Einhorn was like spot on, and that's because we had that nasty inflation period in 2022. So it killed the performance of risk parity. And so we made this prediction in the book. We wrote the book 2 years ago. It came true, but I got those ideas from some really incredible fund managers. And now if inflation bounces, it's going to do another dance. It's going to continue to hurt risk parity. Just look today. There's an Apple bond out there that it's the 2.55% due in 2060. It's a long duration bond. But it's trading at 61 cents on the dollar, Jay.
Wow.
I mean, think about this. This bond was issued at like 102 or traded at 102 in 2021. It traded at 102. It's at 61, Jay. I mean, think about it. It's a $1.5 billion bond. I think it's 1.7. So it's a $1.7 billion face, and those bonds are only worth $1 billion now. So it's a $700 million loss on just that one bond, Jay. That one bond. And multiply that times all the bonds. So when interest rates go up, bond prices go down, and if there's sustained inflation, then all of this portfolio is stressed. So this is why we wanted to say, you want to have a good chunk, and now I would even frame it up to even more commodities. And in terms of the bond quotient right now going to the new year, which I really want to get into, there's a real ticking bomb for the first quarter of next year after the election in terms of the bond market. But recommend like a lot of cash, a lot of commodities, maybe like 50% cash and commodities and 50% stocks. And not a lot of bonds right now.
Yeah, wow. Well, let's dig into it. What are you concerned about going into the first quarter of next year?
And what I mean by bonds, Jay, you can own 2-year bonds, right? 2-year treasuries, that's fine. But so picture in your mind, you're Janet Yellen, you have an election to win in 2024, but your government's spending all this money. I mean, $2 trillion a year. What do? If you need to borrow $2 trillion, Jay, if she had issued $2 trillion of 5 and 10-year bonds, those bonds would have moved like this in the market violently because interest rates up, bond prices down. That's the way bonds work. Interest rates up, bond prices down. But what she did was a very conniving, dangerous move. She didn't want to have all that bond volatility in the election year. So what did she do? She has stacked the deck on T-bills. And T-bills, Jay, T-bills don't move. So imagine if you're issuing $2 trillion of T-bills and interest rates go up. Because they mature in less than 1 year, they don't move. So you have two choices. You're Janet Yellen. You can issue $2 trillion of longer dated bonds, 5 or 10-year bonds. Those bonds are going to move violently in an election year, and it's $2 trillion. And we showed you what happened to the Apple bond, right? That's just one example. But if Apple issued a T-bill, which is, so let's just call it Apple again, a T-bill, or the United States government, that matures in less than 6 months, it's not going to move, Jay, right? So what she did was she sucked the bond volatility out of the market in election year to help the administration. And don't get me wrong, I'm not making a partisan move here. This is something, like I said, the Bush administration pulled every trick in the hat, right? So to try to help McCain. So this is something that goes back, 50, 100, like almost 100 years of games, right, that people play in elections. But now the next Treasury Secretary, Jay, you have in 2024, 25, and 26, 15 trillion, Jay, of bonds that have to be rolled over. And a lot of those bonds are in T-bills. So the next Treasury Secretary has to issue much longer dated bonds because Yellen has stacked the deck against the next administration. So one of the things when you talk to, we run a Bloomberg, you probably see the computer moving behind us. We run an institutional chat on Bloomberg with hedge funds, mutual funds, and pension funds. It's one of the largest platforms in the world with the professional investors. And the conversation that I'm hearing now from the billionaire fund managers that run a lot of family office money, a lot of institutional investors, they think that we're going to have a Liz Truss moment in the United States in like the first quarter of next year when the new Treasury Secretary has to start issuing longer dated bonds. And we just don't have, remember, one of the things I talk about in the book, sanctions, confiscation of property in Russia. We just don't have, because of we've abused the sanctions on all the emerging market countries over the last decade. And Republicans and Democrats, it has nothing to do with politics. Republicans and Democrats have abused sanctions. And then the Ukraine war kind of forced the United States into draconian wealth confiscation, private property confiscation of Russian assets. So all of these emerging market countries are just not buying as many bonds. And there's a lot of interest to Jay. Listen to this. So let's just say there's $40 trillion of dollar-denominated debt. Those the bonds in the world now pay a lot. All these new bonds have issued in the last year. They pay these high coupons, much higher coupons, double, triple what they used to be, like 2020, 21. So these countries have all this cash, and you know what they're doing? They're buying gold, and they're hedging their way out of bonds because everybody's table max long U.S. government bonds. And so because of all the sanctions and the kind of the abuse from the U.S. government over the last decade, emerging market countries, foreign governments, central banks they don't want to hold as many. So we're going to have this like less global demand for bonds over the next couple of years, an incredible new supply of bonds, and it's going to force the Fed to come in and be the buyer of last resort. And that's, once again, that's what gets you this real spectacular move into hard assets and commodities.
Gosh, there's so many potential follow-up questions there. Let's just start with one that I know my audience would care about, and that's the impact of that scenario on real estate prices. So if they're artificially bringing down short-term rates and longer-term rates, 10, 20-year paper starts going up, obviously that's going to drive up mortgage rates. What happens to housing here in the United States?
Well, yeah, so the first stage is, and it's happening now, look at the home builders, the way they're acting the last couple of weeks. They're buckling. And so if you look at the financing in the mortgage market right now, I think we're up to 7% on the more longer dated mortgages. And so that's going to crack the market. But then the Fed steps in, Jay, and then at some point, starts to hold down interest rates on the long end, or it depends on where they try to hold rates down. But they'll hold rates down in some part of the curve, and that will create a weaker dollar. Inflation is going to be great for real estate. But there's two stages to it. There's like the first stage, which we're coming into now, where you get higher inflation, you get higher bond yields, that cracks the market, you get to move down. Then you get the response from the Fed and a move back up. That's like a 2-year trade. So, but overall, I mean, inflation is really great for real estate. You just, like, once again, you want to be along hard assets.
Yeah, it's great for real estate if you own it, not for some of the younger generation, most of the younger generation that haven't been able to leg into it yet, which will come with its own set of consequences, right?
That's what you see on the campaign trail. Kamala Harris I mean, they're creating all these like wacky new programs to try to like support younger people that need to get into these homes, but they've created all these dislocations. But that's just going to, that kind of, any kind of program like that from the government that feeds more capital into it's potential homeowners or home buyers, that's just going to support prices. And so it's just a classic thing with governments, right? And the Fed and monetary fiscal policy. When you play with a serpent in a cocktail, and the unintended consequences of what they've done since COVID, like I said, the fiscal and monetary response to COVID, to the banking crisis to 23, and then the election year juicing of the fiscal is $16 trillion. And they've created so many unintended consequences that they're going to have to come up with all these different plans to get around and these solutions. And it's going to be very interesting.